cost of holding the high level of NIR? Does the high level of NIR increase the cost to the country and increase the debt to GDP ratio?
Yes. We are actually paying a price for holding it in the international reserve, because essentially the Bank of Jamaica is issuing debt at local paper at local interest rates, which, you know, right now the BOJ 30-day repo is at 7.25%, while it's earning less than 1% on the USD that is holding. So there's a so-called negative carry, so there's a cost. However, the benefits of having a high NIR, given the fact that we have a very weak balance of payments position, actually outweigh the cost, or it should outweigh the cost over the medium term once the economy gets back on track.
So a follow-up question is, why should we borrow more and increase the debt instead of using the NIR to pay back?
Well, remember that the NIR that we have actually is borrowed money. So, I mean, what we are doing is we are replacing expensive borrowing with cheap borrowing. So the NIR, we are borrowing from the IMF and multilaterals at 1.5%. If we didn't do that, we would have had to have borrowed on the GOJ market at double-digit interest rates. So we're making significant savings borrowing cheaper. Now, to use the NIR to make investments, for example, we don't have enough we would have had enough net international reserves to pay off all our existing debts. So for example, look at our stock of debt, our stock of bonds. Our NIR pays in comparison to what our stock of debt is. So what we needed to do, the first thing, is to stabilize the fiscal accounts. And the only way to do that is to control the two largest costs. The largest cost is interest expense, the second largest is public sector wages. And we have basically contained interest costs as we have seen with our ability to meet the IMF IMF targets so far during the fiscal year, which I suspect that we'll continue doing in 2011, 2012, as long as we don't get any choice.
Yeah, JC, to add to that as well, your NIR, the healthiness of your NIR is something that lenders will also be looking at. So it's in your best interest to demonstrate that you have reserves in case of emergency, such as what occurred in 2008, 2009.
Absolutely.
Thank you very much, gentlemen. So now we'll progress to the next section, equities market. And we ask our senior financial analyst, Najja Daley, to deliver this section.
Thank you very much, Vanessa. All right, this section of the presentation, we'll be doing an overview and outlook of the local stock market for 2010 and 2011 respectively. Now, the analysis was done from a sector perspective. So what we did was we looked at the entire Jamaica stock market, we broke up the companies and grouped them into sectors. We chose the sectors that were, most responsible for the overall movements of the overall market. We broke them out into 4 sectors, namely banking, manufacturing, investment banking, and communication. And then we created indexes of all the sectors so that we could easily compare them to the JC main market and also track the performance. And this graph here is showing you the sectors broken down and their performance relative to the JC main index for 2010. Right, so the first sector we'll be looking at is the banking sector. Now the banking sector, the constituents are First Caribbean, FCIBJ, NCB, and Scotia. What we saw for 2010 is that the index rose 2.5% versus 2.3% for the JC main index. And we note that the banking sector, it accounts for more than 50% of the entire market. And this is due to the high market cap of First Caribbean and also Scotiabank and NCB. Now, growth in the index was driven by mostly by movements in NCB, which rose 21% for the year, followed by Scotia and First Caribbean, which increased 8% and 4% for the year. The graph there shows the movement. As you can see, the correlation between the banking sector and the overall JC sector is extremely high, and this, as I said, is due to the high weighting that the banking sector plays in the overall market. Now, the performance in 2010 came amidst, we had in the earlier part of 2010, the JDX, which put significant pressures on the banking industry. We saw revenues and profits for the industry down 10% and 5% respectively. We also saw loans for the sector decline 3% and loan losses, provision for loan losses up 24%. This kind of speaks to the challenging economic situation and leading to a lower demand for loans. Now in 2011, what we expect to see further challenges from the banking sector, as you know, they struggle to cope with the low interest rate environment, and also, you know, struggle to increase their loan books. But we do expect, you know, we expect the banking sector to slightly outperform the main sector, due to the fact that, you know, a lot of these banks, you know, they're very strong companies. They're better poised to come out of the situation on top. The next sector is the investment banking sector. This is made up of Barita, Capital and Credit, GMMB, Mayberry, Pan, and Scotia DBG. Now for 2010, we see where the index gained the main index gained 2.3%, while the investment banking sector gained 13.5%. And this movement here was driven mainly by Pan Caribbean and SDBG, who gained 8% and 32% respectively. Now for 2011, what we expect to see is, you know, greater focus. There's been a lot of talk in the industry about, you know, new regulations, and what we expect is to see a lot of focus placed on capital adequacy and leverage. The next slide shows the level of leverage in the industry. On average, is currently at about 9.5.
Najja, just explain a little bit to our viewers what you mean by leverage.
Sure. So what your leverage is, to calculate your leverage, is your total assets divided by your total equity. So, and why it's important to have, you know, fairly low leverage, what it means is that if there's any hit sustained to your assets, it will not wipe out your entire capital base, and it won't threaten the, you know, the business as a going concern. Okay. All right. So we expect to see in 2011 great focus placed on leverage, and, you know, with greater regulation by the FSC, we expect some challenges for the investment banking sector. As such, our 2011 projection is for the investment banking sector to just match the performance of the general market. Next sector we'll be looking at is manufacturing and retail. This for 2010 was the strongest performing sector. It grew 21% for the year compared to the JSE main market of 2.3%. And this was driven mainly by Grace Kennedy and Carreras. Now, what is interesting to note is that the performance for the manufacturing came even amidst a 3.4% decline in the manufacturing sector of the economy. Now, what this speaks to is, you know, technical factors of the market outweighing some of the fundamental factors. And, you know, especially with Grace Kennedy, they had a large increase for the year. Now, due to this mismatch of, you know, the performance of the economy versus what the stock price did in 2010, for 2011, we are expecting the manufacturing index to underperform the main index. And this is due to, one, we don't expect any more growth. We don't expect any growth from the manufacturing sector of the economy, and we expect some of the overpricing to be corrected in 2011. Now, the communication sector, which is made up of cable and wireless, RGR and Gleaner, this index for the year 2010 fell by 1%. Versus the 2.3% rise from the main index, and the index was brought down mainly by cable and wireless, which registered a 13% decline in their stock price, with Gleaner and RGR actually advancing by 47% and almost 15% respectively. Now for 2011, we expect further challenges for the communication sector. We're not expecting, you know, much. Jason alluded to it earlier in terms of economic growth. Economic growth is going to be difficult to come by. It's going to have its effect on consumer demand, and it's going to be reflected in the communication sector in demand for advertising, and this is going to directly impact Gleaner and RGR, as we see in the next slide. So given this, our 2011 projection is for the communication sector to underperform the general market. So overall now, what we expect from the market. We see for 2011, the low interest rate environment is expected to force investors into the equity market seeking higher yields. But the temperate outlook for the economy will lead to challenges for most of the sectors to register any significant profit growth. We expect the banking index to outperform, the investment banking index to match the index, and the manufacturing and retail index to underperform, as well as the communication index. And our valuation index of the market indicates a current fair value of the JSE main index at around 88,500 points, which is about a 4% undervaluation of the main index. So we expect for 2011 about a 4% rise in the main index.